Welcome to the Opening Bell Report.
So if you were watching the markets on February 18th, 2026, and you're looking at the shipping sector, you probably did a double take.
Oh, absolutely.
I mean, honestly, you probably thought your data feed was just broken. It was one of those days where the charts just go completely vertical.
A straight line up.
Yeah, we saw ZIM integrated shipping services, ticker ZIM, just explode. We're talking about a move of over 25%.
Yeah.
In a single day.
It definitely wasn't a standard Tuesday. That vertical line was the market reacting to a headline that, it's been rumored for a while, whispered about, but now it's finally officially real.
Right.
Hapag-Lloyd, the German shipping giant, has entered a definitive agreement to acquire ZIM.
And when you see a move that violent, you know it's not just a good earnings report. Something fundamental has shifted. This isn't just one company buying another. It feels bigger, like it reshapes the whole global shipping map. But, and this is where it gets really interesting, it's not a simple, here's a check, give me the keys kind of deal.
Oh, not even close. If you actually dig into the filing, this whole thing is basically a geopolitical puzzle that's just masquerading as a financial transaction.
That's all, yeah.
You've got national security concerns, you have this thing called a golden share, and a corporate restructuring so complex, they had to invent a new company just to make it all work.
Exactly. So that's our mission for this deep dive. We're going to unpack this $35 buyout offer. We'll look at the numbers, of course, because that's what drove the stock up.
You have to.
But we also have to explain why the market is still, well, a little skeptical. There's a price gap we need to talk about. And then we've got to explore the creation of this new ZIM that was designed purely to keep the state of Israel happy.
That structure is everything. It really is the key. Without new ZIM, there is no deal. But let's start with those headline numbers because they are pretty eye-popping.
Right. Let's get into the valuation. Hapag-Lloyd put a very specific number on the table, $35 per share.
All cash, too.
All cash. No stock swaps, no complicated paper, just cash. And when you add it all up, the total equity value comes in at around $4.2 billion.
Which is a significant valuation. And for shareholders who have been on the ZIM roller coaster for the past few years, this is a massive sigh of relief.
Yeah.
You have to look at the premium.
The premium is huge.
The offer is a 58% premium over the closing price just on February 13th, which was $22.20.
58%. I mean, if you were holding the stock on the 13th, you are having a very good week. That's the kind of pop traders dream about.
And it gets even crazier if you zoom out a bit. If you look at what analysts call the unaffected share price from last August, before the serious rumors started pushing the price up.
Yeah.
This offer is a 126% premium.
Wow.
More than double the value in about 6 months.
So Hapag-Lloyd is basically saying, we think this company is worth double what the market thought just 6 months ago. But here's the thing that I found fascinating. The offer is $35. The stock, it didn't go to $35. It surged for sure. It went up 25.5% to hit $27.85. But $27.85 is not $35.
Exactly. And that gap, that's what the pros call the spread.
Okay, let's unpack that. Why is there a $7.15 difference? If Hapag-Lloyd says we will pay you $35, why isn't the market pricing it at $35 right now?
This is that skepticism we mentioned. In the world of mergers, the stock price, it almost never jumps all the way to the offer price unless the market is 100% certain it will close.
So the gap is risk.
The gap is pure risk. Investors are looking at that $7 difference, which is about 20% more upside, and they're saying, I'm not sure this deal actually crosses the finish line. They're pricing in regulatory and execution risk.
It's not a slam dunk.
Not at all. The fact that it's sitting around $27, $28 tells you there's a lot of fear baked into that price. And that fear comes from how incredibly complicated this deal is. It's not about money, it's about politics.
It's entirely about politics. To get why Wall Street is so hesitant, you have to understand the golden share.
The golden share. It sounds like something out of a James Bond movie. What is it?
So ZIA isn't a regular public company like, Apple. It used to be a state-owned enterprise of Israel.
Right.
And when they went private, the state of Israel kept a special state share, a golden share. This gives the government veto power over certain things, specifically transferring ownership.
Why?
To make sure the country's shipping needs are met during a national emergency. For Israel, shipping isn't just commerce, it's a lifeline. They're effectively an island economy.
So if there's a conflict, they need to know they have ships that will bring in food, medicine, whatever they need. Exactly. A commercial carrier might say, it's too risky, we're not sailing. A national carrier can't do that. And here's the problem. Hapag-Lloyd is German. The Israeli government's position is, we can't have our strategic lifeline fully controlled by a foreign company.
So How do you sell the company without selling the control? That seems impossible.
This is where the bankers earn their fees. They got incredibly creative and came up with a solution involving a spin-off. In the analysis report, it's just being called New ZIM.
New ZIM. Okay. How does that work?
It's a separation of assets. Hapag-Lloyd is buying the global shipping operations, the brand, the customers, the tech network, all the stuff they really want.
So they get the profitable business engine. What does New ZIM get stuck with?
New ZIM gets the responsibility. This new company will be spun off, and it will own about 16 specific vessels and the trade routes that matter most to Israel. So Israel to Europe, Israel to the US, and so on.
So they're just carving out the security-critical infrastructure and putting it in a separate box?
A separate box that, crucially, will not be owned by Hapag-Lloyd. It's being backed by FEMI opportunity funds.
FEMI. That's a big Israeli private equity firm.
The biggest. So by having FEMI back New ZIM, they satisfy the requirement for Israeli control over these strategic assets. The German company gets the global network. The Israeli PE firm gets the security ships.
That's a fascinating workaround. It's like selling your house but keeping the garden shed, because that's where you store your emergency generator.
That's a surprisingly good analogy. And even though they're separate companies, they'll still work together. The analysis notes they'll have commercial support agreements and do slot swaps.
On slot swaps.
Yeah, it's common. Hapag might pay to put some of its containers on a New ZIM ship and vice versa. So they stay connected operationally, just not by ownership.
So on paper, this solves the golden share problem. But going back to that spread, clearly not everyone thinks this is a perfect solution. Who's unhappy?
Well, the first and loudest group is labor. The Histadrut, Israel's big labor federation, and the ZIM workers are furious. They've already launched strikes in Haifa.
Yikes. That's never good for a deal. What's the fear?
The classic fear in any merger? Layoffs. Workers are terrified that once Hapag-Lloyd takes over, they'll consolidate operations, and there will be massive job cuts, especially in the Israeli offices.
And a port strike puts huge pressure on the government.
Which brings us to the second hurdle.
Government approval. Even with this clever, fummy workaround, the Israeli government still has to explicitly sign off. Just because the lawyers drafted a plan doesn't mean the politicians have stamped it.
And that is the Israel risk that the market is pricing in.
That is the $7 spread right there. Investors are asking, will the government really sign this? Will the unions kill it?
Let's talk about Hapag-Lloyd for a second. Why do they want ZIM so badly that they're willing to navigate this whole headache? What's in it for them?
It changes their spot in the global rankings. Hapag-Lloyd has been number 5. Buying ZIM solidifies them as a top-tier player. It's a scale game. It's about capacity.
Totally. They're adding about 3 million TEU in capacity, more than 400 vessels to the fleet. But it's more than just size. They're buying ZIM's agility.
ZIM's always been known for being pretty tech-forward, right?
Very asset-light, very agile. They use a lot of chartered ships, great logistics software. Hapag-Lloyd gets all of that, but, and this is the brilliance of the deal for them, they get it without the valuation drag of the Israel risk.
Oh, that's a great point. Because New ZIM is FEMI's problem. Hapag-Lloyd doesn't have that geopolitical baggage on their balance sheet.
Exactly. They stripped out the risky part and bought the profitable part. It's an incredibly smart move, but it also signals something bigger for the whole industry.
The end of the mid-tier carrier.
I think so, yeah. ZIM was the classic mid-tier success story, not a giant like Maersk, but big enough to compete. With this deal, the industry is now almost completely dominated by these mega alliances. There's very little room left in the middle. You either get big or you get bought.
So let's bring this all back to the listener. The analysis report laid out 3 very specific scenarios. Let's walk through them so people know what they're holding.
Sure. The analysts put probabilities on these, which is helpful. Scenario 1 is deal closes smoothly. They give this a 60% probability.
60%. So more likely than not, but hardly a sure thing.
Right. In this scenario, the FEMI structure works, the unions get some kind of deal, and it all goes through. If that happens, the stock hits the $35 offer price. That's a 25% return from here.
Wait, that's the upside case. What's scenario 2?
Scenario 2 is regulatory delay. This gets a 30% probability. This is where the deal doesn't die, but it gets stuck in bureaucratic mud. Maybe the unions drag it out or the government wants changes.
The dead money scenario.
Exactly. The stock just drifts. It probably trades between $26 and $29. You're not losing money, but your capital is tied up for a year or more.
And the nightmare scenario. Number 3.
Deal blocked. 10% probability. This is if the Israeli government just says no, or antitrust regulators somewhere else kill it. If the deal breaks, the stock crashes back to pre-deal levels. The report estimates that's somewhere in the $15 to $18 range.
Ouch. So you could lose almost half your money. That's a steep drop.
That's the risk reward. You're risking a drop to 15 for a shot at 35.
So what's the actionable insight? If I'm an aggressive trader, what am I looking at?
The report calls this a classic merger arbitrage play. You're buying at 27, 28, and you're betting that the 60% probability is right and that spread will close. You're betting on the FEMI structure working.
And what about the long-term holders, the people who love the ZIM growth story and the dividends?
For them, the analysis is pretty blunt. The growth story is over. ZIM is now a capped asset. The ceiling is $35 set by the buyout offer. The price isn't going to 60 on its own anymore.
Unless a counterbidder shows up.
Which the report says is extremely unlikely.
Why not? Why wouldn't a Maersk or an MSC jump in?
Because of this exact complexity. Who else wants to deal with the Israeli golden share, the Histadrut, the geopolitical risk? Hapag-Lloyd has probably spent years laying the groundwork to even get this far. No one else can just jump into this mess.
So for that long-term holder, this is what you'd call an exit liquidity event.
That's the fancy way of saying it. Take the money. If you held on through all the volatility, this is your chance to get out at a really solid premium.
It's a bittersweet moment, I'm sure. ZIM has been such an exciting, volatile stock. But $35 cash is hard to argue with.
It's a very solid exit. So, to recap, Hapag-Lloyd is buying ZIM for $35 a share. To do it, they have to slice the company in two, creating new ZIM to satisfy Israel's security needs.
And the market is giving you a discount on the stock today because of the risk that the unions or the government could still block the whole thing.
And in the process, the competitive landscape changes for good. We are fully in the era of the mega carrier.
It really makes you think about the intersection of business and, national identity. We like to think of these global companies as being stateless, but this deal proves geography still matters. A lot.
It absolutely does. And that leads to a bigger thought I've been wrestling with.
What's that?
We're looking at the future of national infrastructure. In a world dominated by these mega alliances with 500 ships, can a nation truly maintain a sovereign shipping capability? Is this new ZIM structure, this financial gymnastics, is that a real sustainable model for national security?
Or is it just a legal fiction? A paper shield to make a government feel safe while the real power gets transferred to a German conglomerate?
Is it just a temporary illusion of control? I mean, if a real crisis hits, does a 16-ship fleet owned by a PE firm really move the needle?
I guess we'll only find out if they ever have to make that emergency call. Let's hope they don't have to.
Indeed.
Don't forget to like, share, and subscribe for more.